doesn't seem to me that the Fed is acknowledging that the banking system is under duress here.
In today's video, ARK CIO, Cathie Wood, weighs in on inventory pileups, liability-driven investing, commodity prices, and why she believes that the Fed is making a mistake as they base policy on lagging economic indicators. Wood discusses fiscal policy, monetary policy, market signals, economic indicators, and innovation. Before listening to her, please ensure to smash the like button and subscribe to the channel.
We are in a banking crisis. I was listening to Jane Fraser or reading what she said recently, which is, this problem that we're having right now is very isolated, just a few banks. There aren't going to be many ramifications. It's all under control. The Fed's on it. The FDIC is on it. And as you know, I've been quite concerned about Fed policy generally, and now the banking system. So I haven't really discussed this before now, this particular crisis. And so this is a very important time, and I wanted to share it with all of you. So let's take what's happened in the last year. I began getting concerned about how rapidly the Fed was raising interest rates because I saw credit default swaps, so insurance policies against bankruptcy. I saw credit default swaps moving up for banks broadly last spring.
Yes.
And this is as they started, as I think the markets began to understand this Fed was going to start raising rates at a very rapid clip. And then the yield curve inverted in July of last year. And that was another signal that not all was right out there. The bond market was signaling something. I know you didn't agree that I should have written an open letter to the Fed in October. But the reason I did that is I feel as though there's no debate taking place. Maybe there is, and they all decide unanimously. Right. And all I was saying is, look, credit default swaps are going up. This is insurance policies against bankruptcies in the banking system. You've got an inverted yield curve. You've got commodity prices coming down. You have the gold price actually peaked in August of 2020, and it is in a range. And then, of course, it broke that range. So I was just raising the question about how can you be unanimous when there actually is some conflicting data out there that you should be sharing your analysis with us? Like, how are you responding to this? And so that was more the spirit of the letter. And then I basically said, okay, we've said our piece, and now around this banking crisis, I think all of those variables, the credit default swaps, inverted yield curve, were pointing to two mistakes, two mistaken assumptions in the banking systems. One was that during COVID, when we were worried about a depression, that a lot of banks that were being flooded with stimulus payments were taking that money and investing in safe securities, their government-backed mortgage securities, treasuries, and everything. But they invested long-term, put in the held-to-maturity category. And in the case of Silicon Bank, they were earning really 1.6% on that book. So what was the assumption they made? They made the assumption that, gosh, we're probably going to be fighting a depression here. And surely interest rates are not going up anytime soon.
Right.
So that was the first mistake. And then the second, and it was a pretty good assumption, because we've never had now it's a 20-fold increase in interest rates in less than a year. If you go back to Volcker, it was a twofold increase, 10 to 20%, that shocked the system. And what I like to say is, the system is being shocked, because more so than in the early 80s, because we had 2 weeks ago an inversion in the yield curve of more than 100 basis points. So more than 100 basis points on 4% is a lot different than more than 100 basis points on a 15% interest rate. So I've likened it to the Richter scale. So back then, if you look at 4% over 15, that's 6.5 on a Richter scale in terms of earthquake. If you look at 1% on 4%, or 100 basis points on 4%, that's a, well, what is it? That's a 25 on the Richter scale, which is 4 times. I'd like to get back to that in a minute, but before we get to the yield curve, I just wanted to discussion of the yield curve. The second big mistake that Silicon Valley and these other banks made is that deposits would not go down. We haven't had declining deposits in the banking system for, the latest I've heard is 48. If you look at M2, we haven't had a negative M2 on a year-over-year basis since the 1930s. So part of that, 85% of that, is deposits are leaving and going to money market funds. Or in the case of these, watching Silicon Valley banks, customers waiting outside the bank. These are high-tech investors, and they're waiting in lines to go get their money physically. What does that tell you? Maybe they put some of it under the mattress, when they came out. So deposits are leaving the system, interest rates up 20-fold in 1 year. This is a major, major shock. And it doesn't seem to me that the Fed is acknowledging that the banking system is under duress here. But it seems to me, okay, they're now into quantitative tightening, so they're actually selling, and yet the Treasury bond yield has gone down since last October. It peaked at 4.3%, now we're at 3.6%. And I've always thought, bondholders have to be the most focused on inflation. Long duration. Right. We should as well. And we manage long duration assets. And the 21 and 22, as fears of inflation and interest rates were rising, were just killers for long duration assets. Last year, the bond market. Last year was the worst year for the bond market since the 1780s. So we have never had a bear market in bonds like that. Now that is turning around, and we've seen the long-term treasury go from 4.3 last October to 3.6 roughly. And the way I look at it, a bond investor is trying to protect himself or herself from inflation. They're trying to protect. And so that market, I believe the TIPS implied inflation rate is it about 2.1 or 2.2?
Yeah, something like that. It's very close to that.
Yeah, it's very close to that. And so, and it hasn't deviated very much from that. I think it got to 2.5 or 6, something like that. Now, Janet Yellen has come out and said, hey, we're not guaranteeing everything out there. Sort of the MV equals PQ argument. When people are afraid, they tend to recoil. They don't go out. They're not as free spending. The rate at which money turns over comes down. We saw it crash during COVID, right? And what's interesting, we're watching velocity very carefully. And if you look quarter to quarter, it is starting to tip down again. It had a little bit of an uptick, and now it's starting to tip down again, which would be consistent with the fear you're talking about.